Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
G'day Equity Mates, and welcome back to another episode where we are following our journey of learning to invest. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. Now, we are licensed, but we're not aware of your personal circumstances, so any information on this show is for education and entertainment purposes only. Any advice is general advice. But with that said, my name is Bryce, and it is an absolute pleasure to welcome to the studio alongside me, as always, Mr. What did I say? Mr. Wren. Anyway, welcome.
I was wondering where that was going.
Well, I remember I was listening back to the first 12-part series we did on GSI, and my intro was, his parents call him Alec, but the markets call him Wren.
Jeez, we were good back in the day. What happened?
I know.
I think that might be the first time you've officially welcomed me into the studio as well.
I think so, yeah.
Yeah,
I don't know what's going on.
I'm feeling very welcome here, which is ironic because I wasn't welcome in this interview.
You weren't welcome in this interview. No, I was fortunate enough to sit down with a returning guest from overseas, Jesse Felder, someone we've had on the show a couple of times over the last few years. But Ren, you were off on holidays, taking a well-earned break over Easter. But this is an interview that I did with Jesse. It was born out of his commentary on gold, and given what's going on in the macro environment at the moment, we just wanted to check in with him and get an understanding of how he's thinking about the commodity, but also more broadly, how he's approaching current market conditions and where he's seeing investment opportunities. So, Ren, it was unfortunate you weren't able to join us, but I hope you had a good holiday.
Yeah, well, I am still on holiday time, so I'm going to wrap it there and let's get to your interview.
Sounds good. So Jesse began his professional career at Bear Stearns & Co. and later co-founded a multi-billion-dollar hedge fund firm headquartered in Santa Monica, California. But since then, he's founded Felder Investment Research and is the publisher of the Felder Report, where he writes and provides plenty of research that has been featured in major publications and websites like the Wall Street Journal, Barron's, Yahoo Finance, Business Insider, and more. Jesse is also host and produces the Super Investors and the Art of Worldly Wisdom podcasts. He's an incredible thinker and articulates his ideas so clearly through his writing. So make sure you check out his research and analysis. But without further ado, here is my discussion with Jesse. Well, Jesse, welcome to Equity Mates, or welcome back, I should say, returning guest. It's great to have you with us.
Yes, good back.
So, Jesse, we play the Equity Mates Biz Nerdle company guessing game with all our experts. So the way this works, there's 5 clues. You can jump in at any time if you think you know what the publicly listed company is. You don't have to wait for the end of 5 clues. I have no idea how hard or easy this one will be. Let's just see. Let's just see how we go. Clue number 1.
Let's go.
At $100 billion, my IPO was the biggest in the US for 2020. Clue 2. In 2019, I acquired Hotel Tonight for $400 million.
Hotel Tonight.
Clue number 3, I was founded by Brian Chesky, Joe Gebbia, and Nathan Blecherczyk, and I'm headquartered in San Francisco, California.
Is it Airbnb?
Let's have a look. Clue number 5. Correct. He's nailed it. Airbnb.
Needed a couple extra clues, but...
Well, Jesse, you can now add that to your daily routine. If you go equitymates.com/biznerdle, you can play every day.
I play Wordle and some other, like mind games every day. So don't get me addicted. I'll be checking it every day.
So, Jesse, for those that have just joined us for the first time, you've appeared on Equity Mates for a couple of interviews now. So thank you so much for coming back. We always love reading your analysis over on the Felder Report and listening to your podcasts. So we wanted to get you on today to sort of cover 3 broad buckets, just your views on the current state of markets, specifically thoughts on where gold is currently at, and then close out with a discussion on just where you're seeing opportunities and perhaps where the market goes from here. And there's plenty happening at the moment with inflation, monetary policy, SVB and banking. How would you just summarize where the market is sort of currently at?
Well, I think that the average investor thinks that we've had a bear market, and that bear market is over. We look at where money's pouring into tech stocks and semiconductors lately. Big tech has kind of led the market this year. It's pretty clear investors look at this decline that we had in 2022 as a buying opportunity. And I think the lesson of, bubbles and bursting bubbles is that we haven't hit the bottom yet. I think that we've seen the first phase of this bear market, and there's another phase to come. The first phase has just been the reaction to the reversal in monetary policy and the rise in interest rates, right? Had so much money printed and interest rate fell to, 50 basis points on the 10-year treasury yield. And that created a pretty epic speculative blow off. That once monetary policy is reversed, interest rates kind of normalized to an extent, we've seen markets, risk assets having to start price that in again. And I think that helps to explain why stocks did so poorly last year. But when you look at what typically drives bear markets, recession, and namely earnings recessions, and we are now 2 quarters into an earnings recession, and I think earnings are going to get worse through the year. Right now, analysts expect the first quarter earnings report to be the bottom. But a lot of the leading indicators for earnings that I look at suggest that it's probably not the bottom. We're going to see second and third quarter earnings decline significantly. And so that's not priced in yet in the stock market. And so if I'm right and earnings are going to decline further in second and third quarter, we're going to get this second phase of a bear market, which will be driven by an earnings recession.
Yeah, right. So what we're seeing in the market at the moment, which is a bit of a, markets are performing reasonably well, is what you could say is a bit of a dead cat bounce then.
Absolutely. And it's, it's really amazing to watch investors kind of embrace these rallies, because when you look back at the dot-com bust in 2000, 2001, 2002, had many rallies like this where you saw NASDAQ rally 20% plus dramatically. And it always sucked investors in. They go, okay, great, this is the bottom, and they bought heavily. And then they gave, the rally was given back and some, fell to new lows. And when you look at those rallies in 2001 and 2002, before the final low in late 2002, those declines from those rallies were paying 35, 40% declines from the peaks of those rallies. And so, I really do think this is, you can call it a bounce, you can call it a sucker's rally, call it whatever you want. This is what we're seeing is typical bear market behavior. It's not at all what we'd expect to see at a bottom of bear market and a new bull market beginning.
And over what period of time do you expect this to sort of play out? Like, is it in the next quarter? Like, how are markets getting it so wrong that they're not pricing this in?
Well, it's going to be really interesting this earnings season, because I think that people, like I said, the analysts are expecting first quarter to be an earnings trough, and that companies will return to earnings growth. But so many things, like I said, point to a protracted decline in earnings. And there's one indicator I look at in particular, which is kind of my macro corporates, lead, which is essentially interest rates, oil prices, and the dollar. When you see these 3 things rise dramatically, it has a very important inverse correlation with earnings 2 years later. So when you have a strong rise in interest rates, oil prices, and the dollar, it creates a pretty earnings recession 2 years later. So set from those 2020 lows, for oil price went negative, interest rates were super low. The dollar, sold off pretty hard, and then those have been rallying from essentially 2020 through last year, right? That suggests that over the next 18 months we're kind of a real danger zone for earnings. And until you see interest rates come way down and the dollar come way down and oil prices come way down, you need to see those three things to kind of lay the foundation for a really nice earnings trough and strong earnings in the future. So we're not there. You can also talk about how the pandemic affected big tech earnings and those kinds of things. And now it's actually very similar to dot-com mania and the Y2K scenario, a big forward of demand that was unsustainable. And you saw it throughout the sector. And then in 2001 and 2, when that demand, vacuum appeared after that pull forward, it created a very painful earnings experience for all of those companies. And it lasted longer than analysts expected. And so this, I think, is really similar, where we had a pull forward in demand related to the pandemic, work from home. Everybody needs a new laptop, upgrade to 5G smartphone, whatever it is. And that pulled for a lot of demand. And now we're seeing, just this week it was announced, Apple, computer sales down 40% year over year in March. And so, that's what I'm talking about, like a demand vacuum. We're going to see something similar in smartphones and in other areas. And that's even before you see this, I think, like a mass extinction event in, a lot of these non-profitable startups, which are all, customers of, these big tech companies. They were advertising on YouTube and advertising on Meta and all these things. And so, when that goes away, that's going to be, a problem for these companies as well.
Do you think that the Fed did the right thing with what they've done with interest rates? Have they gone too far? Here in Australia, this month, our Reserve Bank actually paused raising rates. There's a question on whether they do that again this coming month, but it seems the Fed is still very much on the path of raising. What's your sort of sentiment around the action of central banks around the world at the moment?
Well, I think, I've used the metaphor of speed wobbles. I think what we're seeing right now is central bank speed wobbles. If you've ever, ridden a skateboard, I grew up surfing and skateboarding. So, you get going down too fast downhill on a skateboard, or even dumber, holding onto your buddy's bumper while he drives you off skateboard behind. You get, speed wobbles, and that's basically just the board. It happens on bikes too. If you're down, if you're a road bike or go downhill fast, it starts oscillating faster than you can correct. So you either need to just kind of very calmly, try and center yourself to end those speed wobbles, or you're going to just go handlebars, crash on your skateboard, whatever. I think that's where we're at with central banks, where they're so far behind the curve, they let inflation get out of control, waited way too long to try and normalize monetary policy. Now they're so far behind the curve, they're probably going to over-tighten. We're going to get a painful recession. They're going to, Jay Powell's already told us that, here in the United States, if we get a recession, the Fed will use its tools, which are powerful, quote unquote, to address that recession. Using inflation hasn't come back down to target that point, then you're just creating another inflation problem down the road. And so I think they're in this. This is the problem also being data dependent. And Mohamed El-Erian has been a very insightful critic in this regard, that the Fed doesn't really have a forward-looking framework or how to deal with things. The one they had was dead wrong, where they changed the inflation framework and said we're going to go for average inflation targeting right at the wrong time. So now that they're basically being data dependent and looking backwards and trying to steer the economy by looking in the rearview mirror, they're going to be behind the curve on inflation, and then they're going to be behind on I think there's a good chance we're probably already in recession here in the United States. You look at Treasury revenue and things, and it's declining significantly. A lot of other signs, and so the fact that they're probably going to tighten again in May, raise another quarter basis point or 25 basis points, is only going to exacerbate that. And I think that we're in this speed wobbles, and it really takes a steady hand, somebody like a Volcker, to say, we're going to hold rates here. We're gonna just hang out. We're gonna let things work. Might be a painful session, but we need to just kind of do what we have to do to get the economy right on the right track again. I don't have that same kind of confidence in Jay Powell that he's willing to do that sort of thing. He's even said as much. So
didn't the States technically have a recession, but then the Fed came out and said that by their definition, it's not a recession or something crazy like that a couple of months ago? I feel like there was
2 quarters of negative real GDP growth, but we didn't have unemployment rising. And so how they define recession is, it's not just GDP, it's have to have unemployment and other things. And so, but I think the overall point is that I'm looking at is whether it meets the definition of recession or not. We're in this stagflationary environment where nominal growth is maybe still growing great. Maybe it's still running 5-6%, but if inflation's running 5-6%, you're not going anywhere. You're like running as fast as you can to stay still. And that's not a healthy situation. So, I do think, probably looking at a scenario like the 1970s where you have, bouts of inflation, Fed tightens, creates a recession, but they don't, hold monetary policy in a way that's restrictive enough to really put inflation to bed. And this is what we'll see, right? Markets are pricing in a pivot that they'll cut 75 basis points for the end of the year. And, if they were to pivot and start cutting interest rates again before inflation's normalized, probably a longer term inflation problem. There's all types of macro things that suggest inflation is a problem, regardless of the Fed, demographics and deglobalization and these other things, and just the amount of debt that it suggests that inflation is not going away, and the powers that be really don't want it to go away, because that's really the only way we can manage that over any period of time.
Do you have a view on where rates need to get to in order to get back to that 2-3% inflation target?
Yeah, I think historically we would need probably a real positive funds rate. So you need to raise the Fed funds rate above the rate of CPI. CPI came in today at 5%. You probably need a 6% Fed funds rate. And we still have a negative, real Fed funds rate. The Fed funds rate is below CPI. Now, you could also look at something like the Taylor rule, which is, developed by John Taylor to create a guidepost for the Fed to understand where the Fed funds rate needs to be in order to achieve their, stable prices mandate. And you could argue stable prices means 0% inflation, not 2%. But to achieve stable prices, the Taylor rule has said for a while now that Fed funds should be closer to 10%, with where nominal GDP is and all the other inputs into the Taylor rule. So, I think you'd at least need a positive real Fed funds rate, and possibly you might need to go closer to a Taylor rule type of policy framework.
Well, a lot to think about there, but Jesse, we will take a quick break, and on the other side, we're going to get your thoughts on gold, because the last couple of times we've had you on the show, you've been very bullish on the asset class, so really keen to understand where you're sitting on it now. So we'll take a quick break. We'll be right back after this. I'm here with Jesse Felder, founder of Felder Investment Research and publisher of the Felder Report. You can find Jesse's research at thefelderreport.com. I would strongly recommend checking it out. It's a really, really good read. But Jesse, as I said before the break, we first came across you with the analysis and commentary that you were doing around gold. And I think our first episode just completely centered around gold and was a really interesting, eye-opening moment for us. You have been quite bullish on it. I think the first question must be, are you still bullish on gold?
Absolutely. I think for, fundamental and, technical reasons, fundamentally, the price is, for a very long time have been seen by human beings as and it's funny. My wife and I just went through and watched the John Wick trilogy before we go watch John Wick for the new one. And there's no coincidence that they all, in this underworld, they all deal in gold coins. It's because, no matter what happens in the monetary world, whatever outside world, a gold coin is going to buy you a custom tailored suit. Today, 100 years out, 100 years ago, gold coin is going to have the same purchasing power that's always had. So, so it's interesting for me to see that. But, in an environment when your purchasing power in terms of the currency is being debased, your purchasing power is going down. And it's going down more rapidly today than it has since the 1980s. You need to find things that help you protect purchasing power. Gold has done that for literally thousands of years, and so I think it serves that purpose, which is important in an environment like today.
What we haven't had the chance to ask you about is Bitcoin. What is your thoughts on the new digital gold? Where do you sit on Bitcoin?
To me, Bitcoin has no intrinsic value. It is Warren Buffett was talking about it today on CNBC. It's a speculative vehicle, and I think it's proven itself in that respect, that it has not a very good inflation hedge, and it really doesn't have any correlation with inflation or the dollar or anything like that. The top correlation is with essentially unprofitable companies that trade on the NASDAQ, most speculative securities on the planet. So I look at it as a vehicle for speculation.
Yeah, fair.
That's about it.
So for retail investors like ourselves, how should we think about having gold in our portfolio? From like an asset allocation point of view, if you're able to give insight into the weighting that you might put towards it, we kind of often hear, 5% is probably a good sort of weight to consider. But how should we think about gold in our total portfolios?
I think it's critical right now. This is something I've tried to make an important point to emphasize for the past 5, 6, 7 years, which is when you look at the greatest asset allocators on the planet, whether it's Swenson or Ray Dalio or anybody else, the big difference you'll see between what they do and what the average investor does is that not only do they have stocks and bonds, they have a very healthy allocation to real assets. Now, that's going to be things that do well in an inflationary environment, because stocks and bonds typically do poorly in an inflationary environment, which a lot of investors are winning last year. A balanced 60-40 portfolio had its first year in a long time last year. And so if you only own stocks and bonds, you better hope that inflation comes back down to 2% and stays there. Better than hoping is to say, I'm going to take a piece of my overall asset allocation mix and put it towards things that protect purchasing power. That's things like Treasury, protected securities, inflation adjusted bonds, commodities, and precious metals. So gold is a part of that. And I think, some people prefer real estate is also a part of that. Some people prefer different types of real assets. For me, I think when you look at, currency diversification, I want to be diversified across asset classes. I want to be diversified across currencies. Then what currency is more attractive than others, or gold can't be debased or valued. So that's a good hedge against currency debase. And so I think it's important to have some type of allocation. You can look at my friend Meb Faber wrote a great book on this topic called Global Asset Allocation. And, it's anywhere from 5% to 25% you'll see across these asset allocation kind of models. And so somewhere in that range, I think is a good long-term scenario. Now, I think for like tactical investors, you might want to even have a bigger allocation than that based on the type of environment that we're in and the technicals, essentially the momentum and the technical pattern in gold is very bullish, which would argue it's a good time to be gold.
Just on that, a lot of the stuff you write does sort of center around using technicals, and you're suggesting that it's I guess pushing towards an increase in price for gold. Over what period of time are you expecting this to play out for gold?
I think gold's had a really good run over the last few months. It might, need to seasonally, you look at the seasonal pattern, it would suggest that, gold could have, take a little bit of a breather here for the next couple months. July, September are the next kind of really bullish seasonal period for gold. And, seasonality is usually not super important in a lot of different asset classes. It is in gold because there are seasonal factors to the way physical buying in India happens in China and whatnot. And so, seasonal pattern is more important for gold. So it could take rest, but it's also breaking out in the process of breaking out in terms of, in dollar terms to new highs right now. And it's very possible that if, the Fed is done hiking and appears as going to start cutting, gold could break out strongly higher. Since the peak in 2020, over the last 2.5 years or whatever, gold formed a very clean bullish flag pattern. In technical analysis, a bullish flag is when you see, a trend go on for a period of time and then basically create like a sideways pattern before it breaks out and moves higher. It's essentially like a continuation pattern. So gold has been in that bullish flag pattern for the past 2.5 years or so. And if you look back, what did gold do 2018 to 2020? A really good, I think, example of what it could do once it breaks out to highs. So that's about a $700 price move, 2018 to 2020, which could be what's ahead of gold over the next year or two.
Well, that kind of moves nicely into opportunities, and you sort of mentioned at the top that it's sort of a bit of a false horizon at the moment, and for the equity market, we could be looking at a continued bear market for the next 18 months or so. But are there any parts of the market that are exciting you at the moment?
Absolutely. I mean, the commodities sector generally, I mean, the two areas within commodities I've been focused on are precious metals and energy, so oil, gas. And the oil price is another one that just looks very, very bullish to me. We've had this consolidation in the oil price has been longer since the 2008 top. It's essentially been in a 15-year long, not quite 13, 14-year long consolidation pattern, where we have, not even tested those 2008 highs. It broke that downtrend last year, which is, a very bullish sign. When Paul Tudor Jones, I'm going to botch the quote, but he said, when you see, a very clear kind of consolidation range and a price breaks out above it, it's a very clear sign that's going to continue going in that direction. And so momentum, I think, if anything to learn from technical analysis, is just how to look at momentum, because when something has momentum, it's very strong momentum, it's unlikely to reverse directions at that point. Usually major reversals come when you see momentum slowing down and waning, or kind of a sign that things are ready to roll over in that direction. So I think the oil price has very strong long-term momentum. It's breaking out above, levels, and this over the last year or so, it's come back to test those breakout levels, on a technical and from a sentiment standpoint. People got very, very bearish on the oil price in the last, month or two, thinking, oh God, we're going into recession. Oil price is going to crater again. But what's different this time is that the frackers here in the United States are running out of new wells. And so when oil prices were really strong in 2010s, frackers would go and pump a bunch of new oil, and then ended up getting a crash in 2014 in the oil price. That crash from 2014 to 2020 was a very, very painful bear market for energy. They can no longer pump like mad like it did before. And so that supply response just isn't there anymore. That is a key differentiator for the type of cycle that we're in now. I personally believe, I think we're in the early innings of a new commodity super cycle. Oil prices, gold prices, are in the early stages of a multi-year move higher.
Wow, love to hear that. We'll definitely take note of that and keep a close eye. You mentioned momentum there, and technical analysis is something that I don't spend a lot of time doing, but can understand the benefits of including it as part of an investment process. Is there a simple way for those, or for us listening at home, to be able to measure momentum for a stock or an asset class that we're looking to get into, to understand, does it actually have momentum behind it?
Yeah, I think if you look at, RSI is one of the most, you pull up a chart on stockcharts.com or anywhere else, and RSI and ACD are usually the two technical indicators that come up. I think people make the mistake of looking at overbought and oversold indicators on RSI as signs that, the trend is ready to reverse. And I think that's not the case. If you see really high RSI readings or really low RSI readings, it's to me, that's a sign that's a very strong trend, and price is going to continue in that direction for time. So you could use something like that. I think it's also very easy to use things like moving averages. I think the first place to get started with technical analysis is to use just moving averages. A trend following framework. So if Paul Tudor Jones has said, I don't need to know anything about security other than whether it's above or below its 200-day moving average. If it's above the 200-day moving average, it's in an uptrend, I want to buy it.
Interesting.
If it's below the 200-day moving average, it's in a downtrend, I want to sell it. And so that's a very simple kind of framework, I think, for investors to, if you're looking at a security or an asset class or whatever, just you can look at 200-day moving average versus price and understand kind of what the trend is.
And so 200-day versus 50-day, that 200's the one that you sort of would suggest starting with?
Yeah, I think if you look at price versus the 200-day moving average, somebody else, other trend followers might use the 50-day and the 200-day. When the 50-day moving average is above the 200-day, that's an uptrend. 50-day crosses below the 200 moving average, that's a downtrend. And when you look at, if you just apply it to the S&P 500 index, I mean, you have really effective market timing methodology right there. Go back and look at 30 years history of that indicator, and it keeps on the right side of the market the vast majority of the time, and keeps you out of the market during bear markets and in the market during bull markets. And so just understanding what the trend is, I guess, is the first crucial step to utilizing technical analysis.
Well, Jesse, we have reached the end of our time together. So thank you so much. It's been a fascinating discussion. I've taken so much from it. And I know the Equity Mates community love when you come on the show, always really clear thought on current sort of state of market. And as I said, if you are listening at home, make sure you check out the felderreport.com to keep up to date with Jesse's thoughts on markets and different asset classes. It's been an absolute pleasure as always, Jesse. Thank you so much for your time.
Thanks, Bryce. Always good to chat with you. Appreciate it.
And Equity Mates, before you go, just one call out. If you could please leave a 5-star rating and a review for the Equity Mates Investing Podcast, we would really, really appreciate it. It goes a long way to helping us get in front of new ears and to support the Equity Mates community. So if you could just leave 5 stars and a review, it would be very much appreciated. But we'll be back next week as always. Have a good week.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.